Hi everyone, this is Gary, and I wanted to review the templates that you're going to be using this week to do your homework problems. We have three problems, P1-40, P1-43, and then P1-54. So let's take a look first at P1-40. As you can see here, what you're going to be doing is we have a listing of all of our accounts, assets, liabilities, and equity. And underneath each of those, you see different accounts. We see cash, accounts receivable, office supplies, and land, and those are all our asset accounts. Under liabilities, we have just one account, and that's the accounts payable. And then under equity, we have capital, withdrawals, service revenue, rent expense, and advertising expense. And if you'll notice, there's a beginning balance on each of these. If you don't see anything in there, it means that there is no beginning balance in that particular account. So I've given you the beginning balances, and what you have to do with each transaction is that you then have to record exactly what has happened in that transaction. Every transaction is going to affect at least two accounts. In some cases, it may be more than two, but there'll always be at least two accounts that are affected by a transaction. So that means that you have to enter something into at least two accounts. So for instance, in transaction A, and I'm going to use a different than what's in the textbook, just to give you an example. Let's say that the company paid cash in order to purchase office supplies, and they paid $200 in order to purchase office supplies. So if this company did pay cash in order to purchase office supplies, then you're going to decrease cash. And so we're going to go there, and we're going to put in minus 200. And then over in office supplies, we're going to plus 200. Sorry, that's a plus sign, 200. And so that's all we're going to put in for that transaction. And then in the next line, we're going to put the balance. So we're going to have 2,200 because we're subtracting 200 from 2,400. And then here, since it began with a zero balance and added 200, we're going to put 200 as the balance. So you're going to do that for each transaction. So for transaction B, let's say that we that the owner withdrew money from the capital account. So we're going to decrease cash by, let's say, $1,000. And we're going to withdraw money from the capital account for $1,000. So then we just carry down the balance. Sorry, that's wrong. And we just continue going through each transaction this way until at the very bottom, we're going to carry down all the balances for each of those accounts. So you'll have a balance in every single one of these accounts for cash, accounts receivable, office supplies, and so on. Now, I've given you a hint here that your total assets are going to equal $29,650. Your total liabilities plus owner's equity is also going to equal $29,650 because assets always have to equal liabilities plus owner's equity. So you want to add these up. You want to add up your assets and make sure that they add up to this $29,650. Then you're going to take and add up your liabilities and all your owner equity accounts and make sure that they add up to the $29,650. Now be careful because withdrawals subtract from the equity account, as do expenses. So make sure that you take that into account. Be careful with certain terms that you'll see. If it says that the company has received, sometimes they'll say received cash, other times they'll just say received. Or you'll just see that they paid. They won't necessarily say that they paid cash. But if you see those words received or paid, then you know that cash was involved. If they use the term performed services on account, that means that there was no cash involved, and you would be If they perform services on account, then you would be affecting this accounts receivable account. If they purchased office supplies, for instance, on account, then there's no cash involved. They didn't pay cash for it. They put it on account, and that would be the accounts payable. So when the company performs services on account, you're affecting accounts receivable. If they purchased something on account, then it's accounts payable. Okay, I'm going to be posting a little explanation of accounts receivable and accounts payable in a separate post in DQ1 to help you understand that further. All right, let's go on to the next problem, P1-43. In this particular problem, they give you the information that you're going to be able to create the income statement, the statement of owner's equity, and the balance sheet. So all the numbers that you're going to be putting in here into these three separate statements will come from the homework problem itself. The numbers are there given to you. So one thing I do want to point out is that you're going to want to list your revenue. It would be service revenue, and then you're going to put your amount there. Your expenses, make sure that you make sure that you put in the title of the account as well as the amount. Okay, so let's say it's rent. You're going to want to type in rent expense, and then let's say that it's $100. You want to put those in. Make sure you put in both the name of the account and the dollar amount. Then you total up your expenses in this line, and then you're going to take your total expenses and subtract that from your revenue to come up with your net income. So if you notice down here, I have all the different available accounts that you'll be using up here in the actual template itself. So you do that for the income statement. You then fill in the accounts. The account names are already filled in here for you. And you want to notice that Adams Capital, December 31st, 2015. And then you put in any owner's contributions, and then any net income, and this will come, the net income will be what you calculated here in this income statement. You just pull that over to the statement of owner's equity. Then any withdrawals that are made, and then you'll have an ending capital. So you have your beginning capital, you add any owner's contribution, you add the net income for the year, subtract withdrawals, and you'll come up with your ending capital. Your balance sheet is going to have listed all of your assets, your liabilities, and your owner's equity. And again, you want to list the name of the asset. Let's say it is furniture, and the amount that that account has, that the furniture has. Then you'll add that all up and come up with your total assets. Then you're going to list your liabilities, again, putting the account names in these locations and the amounts over here. And then you'll have a total liabilities. Then you'll have your owner's equity account. And again, you're going to take that balance right from this statement of owner's equity, your ending balance there, and just bring it over here. And then you're going to add the liabilities plus the owner's equity. Now, please make sure that your assets equal your total liabilities plus owner's equity. If they do not, then you've made a mistake somewhere, and you have to go back and find out where that mistake is. Again, all the available accounts are listed here for you to choose from. The last problem is similar to a combination actually of P140 and P143, of course using a different company and different numbers. Now, you'll notice that in this particular case, there are no beginning balances, and the reason for that is because it is a new business. So there is no beginning balance. All right, so you're starting off fresh. It's zero across the board, so you're going to be putting in your transactions in each of the places that you'll see where it says 2 means that there are 2 different transactions there. Then there's a transaction here for 3, a transaction for 4. And again, you want to carry your balances all along here so you don't lose track of your balances. You do, again, just as we did in P140, you're going to list each of your transactions. Remember, you'll always have at least 2 accounts affected. You may have more than that. For instance, you may pay cash and you may have paid 2 different expenses. So you're going to be affecting cash plus 2 different expenses. But generally speaking, there'll be at least 2 accounts that are affected. Again, keep in mind that when it says paid on account, you're going to be using these accounts payable. And when it says that it performs services on account, you'll be using accounts receivable. In each of those cases, cash is not affected. So you're going to be coming up again with your balances for each of these accounts, and your assets will equal $27,450. Your liabilities plus your owner's equity is going to be equal to $27,450 as well, because assets must equal liabilities plus owner's equity. Now you'll notice also that, and what confuses a lot of students, and I'll just give you a heads up, that on the 21st, there are 2 different transactions that take place. But I want you to think about the second transaction. It says hired an administrative assistant to be paid $2,055 on the 20th day of each month. The secretary begins work immediately. You want to think about whether something that occurs in the business actually is a financial transaction, because only financial transactions get recorded. So keep that in mind when looking at the 21st of the month. Only financial transactions where there is actually an exchange of cash or whatever, an exchange of financial services takes place, that's when it gets recorded. Not every transaction that occurs in a business is a financial transaction that needs to be recorded. All right, then once you have all of these balances, then basically you're going to be pulling each of these accounts and creating your statements just like we did in the previous problem. So you're going to create your income statement, and you're going to take your revenue account, service revenue, put in the amount, list your expenses, their amounts, total your expenses, and then for net income, subtract your expenses from your revenue. And again, here are your available accounts. The next one is to do your statement of owner's equity. Now remember, this is a new business. So it began on December 1, 2016. When there's a beginning capital of a new business, there is no capital. So this would be a 0 balance, just to give you a hint there. Because it's a new business, there's no ending capital from the previous period, so there's no starting capital. The owner's contribution then gets listed here. And then your net income, which can be taken from this previous requirement that you had to do. You fill out that income here, any withdrawals, and then your ending capital. And again, all of these can be taken from your first requirement because you have listed, for instance, all of the withdrawals, and you'll have a final balance there. So you're going to be able to extract all of this data from this first worksheet that you do. After the statement of owner's equity, we're going to be doing the balance sheet. And again, you want to list all of your assets, their account names, as well as their balances, the liabilities, their names, and their amounts. You want to total your liabilities, and then your owner's equity, which is going to be extracted from the previous requirement, the ending capital there. And then you're going to add your owner's equity to your liabilities, and your total liabilities and owner's equity, remember, must always equal your assets. So if they do not, then you've made a mistake somewhere along the way. And again, here are your available accounts that you're going to be using to fill out this information here. Okay, I think that is everything that I wanted to tell you, and I hope that this helped you. Again, if you have any questions, you can always call me. My number is 602-639-7378, or you can shoot me a question in the individual form or the question to instructor form. And good luck on this week's homework. Thanks so much. Bye now.